Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.
Chapter 2. Depreciation of rental property. In this chapter, we will look at the basics of depreciation. Depreciation describes the recovery, through yearly tax deductions, of the loss of property value over time due to wear and tear. Three main factors determine how much depreciation a taxpayer may deduct each year. First, depreciation is determined by a taxpayer's basis in the property. Secondly, depreciation is determined by the recovery period for the property. Finally, depreciation is determined by the method used to depreciate the property. A taxpayer may only deduct depreciation on a property used for rental purposes, and it should be noted that depreciation reduces a taxpayer's basis in property when figuring gain or loss from a subsequent sale of the property. In order to depreciate property, a taxpayer must meet four requirements. First, the taxpayer must own the property. Second, the property must be used in an income-producing activity, such as being used as a residential rental property. Third, the property must have a determinable useful life. This means that the property will eventually wear out, become obsolete, or lose value. Finally, the property must be expected to last more than 1 year.
Like what you see? Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.